everybody. Welcome to our series. This is your fund manager speaking. And today we have Mr. Tahir Basha with us. Tahir, thank you for doing this. Tahir,
Pleasure.
Tahir is the CIO of Invesco. He's been with Invesco for more than 4 years now, before which he was with Motilal Oswal as a senior fund manager, I think more than 6, 7 years there as well, which is where I met him for the first time there as well in Bombay. So Tahir, you have an interesting fund launch now, and we thought we'll have a quick chat with you on your thoughts on the NFO. Invesco India ESG Equity Fund is on, and we do a lot of recommendations of other Invesco schemes as well. So
Sure.
Tahir knows that. So Tahir, before we get into the ESG theme, I want to just check a quick discussion on COVID. I know it's done to death now, but for me, I keep talking to various fund managers and business people, and I want to understand how COVID has changed the world of business and therefore the world of investing. Because sometimes not necessarily the both are connected. Because I've heard fund managers or analysts rather say that business is not looking good, but let's invest double to ho hi jayega. In markets like this. So tell me, how has COVID impacted the world of business and investing?
So I think we've most of us, at least at the start of the pandemic and the lockdown. I'm talking about, let's say, the period between April and July, August. We were all, of course, battling a lot of stuff. We were almost battling for our lives, more or less, and it was something which none of us had ever experienced. So I think it was. Keeping in mind the circumstances which were surrounding us at that point in time, it was quite logical to expect that people would have a lot of anxiety, a lot of fear in their minds, and we were we are conditioned as such as humans to only think about negative consequences at that point in time, around that situation. But I think what has then happened is that over a period of time, I think there have been we've almost as a human race glossed over some of the positive outcomes which or the positive upshots which have also come about as a result of the pandemic. And I think the one key positive outcome which has happened is clearly the kind of productivity increases that we have seen as a community at large, and all of us as a tribe, the way we have been able to kind of deliver a lot more during this period, despite all the challenges. So I think it's at one level a vindication of humanity, if I were to call it. I mean, the human spirit, and it so never bet against the human spirit is what clearly comes out as a important consequence of the whole pandemic. I think it changed our lives in quite a number of ways, especially when we look at adoption of technology, and not just in terms of digitization or talking to each other on forums like Zoom, etc. But I think it was an awakening to the use of technology in a more powerful manner compared to what we've been used to, or appreciating technology, not just as corporates, but even as households and as families. And I think we've had widespread adoption of technology across the board, whether be it for educational purposes, or whether be it for family, social related matters, or whether it be for business and investments. So I think that is something which has been a very strong outcome. I think from a corporate standpoint, there has been a great realization with regard to the kind of cost structures that companies should have or can have. I think many of the corporates were probably almost had taken most of the cost elements as something which was a given, and never probably would have thought a little more deeply about whether those costs were necessary or could have been avoided or could have been replaced with something more powerful and led by technology. So the whole adoption of digital in all our in all our areas of life has been very, very forceful. And I think quite a number of these costs may turn out to be permanent. I mean, it is not necessary that all of these will come back with the same intensity as what they were pre-pandemic. So I think every one of us, I mean, uh, uh, corporates, whether it is manufacturing companies or even service-related industries like ours, have all kind of tried to gather our heads around some of these elements which probably are redundant and can be clearly done away with. Uh, I think there have been a few things. One thing which is to my mind, which comes about as something which is accelerated as a trend, which probably was lying in hibernation for a while, was maybe a sector like real estate for that matter in India. I mean, we've had 10 years of 10 to 12 years, almost a decade of very muted, activity around the real estate sector. In fact, it has been a big drag on our economy, as we all know it, because of a lot of supply, affordability not being there, and as a result of which it having affected many other related sectors as well. Uh, I think that suddenly has become a sector which has really got a shot in the arm as a result of the pandemic. Uh, uh, the transformation of the sector had actually already begun sometime in 2016-17, gradually when the laws around real estate changed, especially when RERA came into existence. So essentially, there was a lot of um, effort to organize this sector, which has really been a very, very
Yeah.
unorganized market in India. So that was the first step, the first beginning. As time passed, then what we had was, affordability of real estate started to increase as a consequence of two things. One is that our incomes, no matter whatever the conditions around us, but generally income levels have gradually only crept up. Even maybe a little bit of interruption during the COVID times, but by and large, incomes have steadily only risen upwards. Uh, and along with which costs of real estate have either been stagnant or probably have gone down, especially over the last almost a decade or so. So, along with which now then we have a scenario where over the last 3-4 years we're seeing a consistent correction in interest rates, and that has further boosted the affordability of the space of this product. And so, affordability index of real estate was going up. There was this whole reorganization which was happening to the sector, and suddenly the pandemic acted as an accelerator, where demand for real estate went up. The other one thing which actually happened before that was even regulatorily, there were costs which were being reduced. So what also added to the affordability of the whole housing sector was and real estate sector was the fact that some of the state governments, like for example, Maharashtra has cut stamp duty, Delhi has reduced their circle rates. There are a few other states which are also looking to do the same thing. So suddenly we've also seen positive reactions or support coming out of policy measures as well. So I think the whole sector has then led to becoming a lot more vibrant than what it was for almost a decade. And of course, like as I said, we got a shot in the arm as a result of the COVID, where people actually started to buy homes. Probably they wanted to move to bigger places, or probably wanted to just move into a house of their own, considering the fact that it was going to be a lot more work from home. So, so all that is, helped a sector which one would have not thought that would get
Yeah.
helped by something like a pandemic. So I think there are good number of such things which have turned out to be positive experiences as well, over and above the fear and the anxiety that we all have lived with in the last almost a year. So that's what I can probably think of. I'm sure in everyone's mind we've had many of our own experiences, good as well as bad, about many things which we were probably not doing. There are a lot of things around the whole social milieu with regard to being able to interact with people, stay at home, spend time with family, reduce wasteful expenditure. I think they were all be a lot more caring. Probably become many of us might have become even more spiritually inclined, I'm sure. So I think these are some of the other effects which I can think of over and above what I can relate to with regard to either business or markets.
So tell me, how do you differentiate, say, between a good business and an investable business? A business may be good but may not be investable, right? So how do you differentiate between the two? Is there a difference?
Yeah, I think, I mean, if it is good, but if it is not investable, I could think of, you know, one or two reasons which probably could lead to that. So one is, of course, the fact that it is not a listed entity. It is not a business through which you can play through a vehicle which is relevant to play that theme or play that business. Or so it is essentially a private company. That could be one of the, uh, reasons or something which would probably come in your way in order to invest in a good business. I think sometimes you might have a good business, but you're not really very sure about the management, and it is not necessary that a good business needs to necessarily be run by a good management as well. You have many instances where it's a very good business but not great management, and uh, uh, it's the other way around as well, where there is a great management but the business is not as great. So I think uh, that could be the other reason that you don't really confide or trust in the promoter, even though it's in a business that is pretty exciting. The other third thing, which could probably be fleeting and may not necessarily be permanent, is you want to buy good businesses at a good price as well. So yes, I understand that good businesses probably you might want to pay a little extra. So it is better to buy uh, a good business at a fair price rather than buy a fair business at a very good price. So I think to that extent, valuations might probably come in your way at times, but that is something which markets always gives you an opportunity, uh, and that can probably be overcome. But otherwise, I think by and large, beyond these three, I think uh, if your starting point is that it is a good business, then I think it is half the battle won with regard to investment choices.
Fair enough. Fair enough. So, your thoughts on ESG as a theme, and is it fleeting or is it to stay? And your framework of the scheme that you're opening up now. So,
So yes, I think I kind of can't deny the fact that look, we have seen substantially higher noise level of, I wouldn't say noise level, but relatively higher levels of uh, communication as well as interest with regard to ESG in the more recent months. But I think it was a theme which was actually only building up over a period of time, and time comes in the life cycle of everything where one feels that it is a lot more noise than reality. But I think it was not something which has just emerged overnight. I think we have been subtly, as mankind and humankind on this planet have become more and more responsible, or at least becoming more and more conscious towards being responsible towards several things uh, which surround our lives. And it's not a sudden awakening. It is something which has been gradually building on all of us in many ways, especially over the last decade. I think climatic related issues or environment related issues have surfaced in one form or the other, um, either through natural disasters or through socialist movements and all those kind of things. So it's not something which has been which is suddenly we all of us have woken up to. I think corporates also at one level have been kind of preparing themselves gradually or trying to enhance. Government regulations are nudging us, whether it is our own domestic government regulations or whether global regulations or being part of some of these large world forums, which also brings in their own nudging and brings in their own challenges and push factors which take you in that direction. So I think it was steadily building up. What has probably become a little more prominent these days is that it is getting woven into to the investment world as well. So environment, social, and governance related issues, or particularly environment and social related issues, were already uh, um, being experienced in our lives. But within businesses, I think they have started to gain a lot more importance in the recent past. And I think we don't have a choice because uh, we, of course, are leaving behind this planet for our future. and we have to prepare. We have to make sure that we at least leave it in good hands. So it will be important for the current community to execute that responsibility. So I think there is a good amount of awakening. I think I don't know about. I'm sure it is the experience with many of you. I've seen now sustainability related topics being actually taught and discussed with my own kids, and who are probably in the third and the fourth standard. So they're starting off very early in their lives, becoming aware of such things. And I think that's again a very important indicator of the importance that this thing is getting. So I think the time has come, and the earlier better. The earlier the better. I think corporates, like as I said, are also getting more and more responsible, because a lot of value can either be built or destroyed. In our opinion, if someone is sensitive or insensitive to ESG related factors, I don't think corporates now have the wherewithal or the liberty to disregard ESG related matters in their journey. So we see a lot of corporates which are not even involved in manufacturing. For example, they are service related companies, but yet are very conscious or very particular about the kind of social and governance related risks that they run. And I'm talking about very large groups, very prominent brands in India, who are reaching out to investors uh, to to understand as to what they need to do at their end in order to enhance their commitment or their uh, approach to ESG. Simply because they know that there is a lot of shareholder value and overall stakeholder value, if not shareholder value, which is linked to delivering on ESG principles. So sustainability, sustainable investing, and ESG consciousness, I think, is only rising amongst investors as well as corporates. Uh, at our end, at Invesco, we have also, we globally have been very ESG focused for a very long period of time now. Uh, we've been in at Invesco globally. We've been at the forefront of running ESG strategies for now well over 30 years, and we've got more than $30 billion of dollars of global assets actually residing in ESG centric strategies. So that's not a small number. That's not a small time over which we've been working on this. Uh, it's just that now, even at a global level for us at Invesco, we are becoming a lot more sensitive to ESG across various investment centers around the world. So maybe perhaps it was earlier more of the regions like Europe, but now it is extending to Asia. It's also extending to the US, and so on. So I think our starting point as far as ESG as a firm is concerned goes back a lot in time. Uh, I think at the other reason why we are getting excited about ESG is that we think that ESG factors are going to become material information, uh, uh, or will provide material information from the point of the corporates for us to make important investment decisions. I think up until now, uh, most of us as investors have relied on financial information largely to process or to understand or evaluate corporates. I think ESG information will become equally important and material as information which will be required to judge a company's future going forward. So a lot of corporate, uh, 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 corporate future will be essentially uh, will be deciphered using ESG related factors. So I think we don't have the freedom to now ignore ESG related information coming out of companies as we go along in being able to make sound investment decisions.
So you are saying that investors going tomorrow are going to be much more conscious than investors are today or were till today, right? So what's the framework that you are looking at
Sure.
in terms of
Yeah.
the scheme?
Yes. So, we at one level, when we look at ESG at our end, what we do is two things. One is that we are looking at ESG as a risk element, or as a set of factors which will allow us to control or mitigate risk. So
Mm-hmm.
it is not, in our view, only about enhancing returns. Yes, there are certain data points which also uh, probably conform to the fact that investing in ESG centric strategies over a period of time does enhance shareholder value compared to, let's say, non ESG centric strategies. So there is evidence of that as well. But primarily for us, we are thinking about ESG more as risk elements, and that is what I said, that corporates probably do not have the option or the liberty now to disregard this, because faltering on any one of these elements can lead to destruction of value. And backlashes, with whether it is social backlash or government backlash or shareholder backlash, can be quite severe when one corporates try to disregard any one of these areas. So we think that our starting point as a framework is more of risk control, and we believe that over a period of time, risk-adjusted returns with ESG centric approach uh, would uh, would lead to would lead to better outcomes compared to non-ESG centric strategies. Uh, the other thing that we start off as a high level principle is that we don't look at ESG as a static feature. What we are looking for is companies where we want to assess what is their ESG momentum, in the sense uh, uh, they would, let's say, be having a certain level of ESG compliance, and which probably either qualifies them or doesn't qualify them from the purposes of featuring in our portfolios, for example. But that is how things are as of now. That doesn't mean that the company is non-investable forever. What we are trying to get at here is to see over a period of time how does a company respond to evolving matters on ESG, and how are they trying to rectify themselves or improve upon these matters. So what we are looking for is ESG momentum, in the sense that if a company is found to be improving on ESG scores over a period of time, uh, because they were low on governance and they've improved governance characteristics, or probably they've done a few things which mitigate environmental related risks or anything else, then there is a chance that what is probably non-investable from an ESG standpoint today might become investable over a period of time, and vice versa as well. That a company,
Right.
if it all is ESG compliant today, but probably slips on governance or some of the other issues, it can lead to it falling out of favor from the minds of investors. So I think it what we are looking for is ESG momentum. So nothing is cast in stone. We are giving enough liberty to corporates to enhance, improve, enrich on their ESG sensitivities. Uh, what we do at Investco as a brass tacks framework is that we are using uh, a almost a 25 point scoring system in order to be able to assign a numeric or a objective value of ESG to a corporate. As you can understand, E, S, and G are to a great degree qualitative factors, and it is important to convert this into something which is more scientific and a lot more objective for us to be able to assess them as of now and as we go along in future as well. So what we're doing is that we are using almost a 25 point framework where we are dividing these factors are these 25 factors are divided across these three elements of E, S, and G. The starting point for these factors is what is called as the business responsibility report, or the BRR, which is supposed to be the part of the annual report as required by the Companies Act, um, uh, uh, which corporates, some of the largest, I think it's probably currently about 500 corporate, the top 500 corporates are regulatorily mandated to release their BRR. Now, this
Right.
BRR is a document or a section which essentially talks a lot about measures which have been taken by the company in their respective line of business to enhance on matters related to environment, social, and governance. So that becomes a good, uh, starting point for us as well to be able to score or to assess these companies on the set of these 25 factors. And what we are then doing is that we are converting that into a combined, score. We are using a range of 1 2 3 as a scoring pattern, one being so it's an inverted scale where one is actually a better ESG score than three. uh, what we are then doing is that we are applying certain cutoffs and certain thresholds where, let's say, for example, we would say that any company which has an ESG score of over 2.5 or 2.5 would not be eligible for the purposes of investing in a strategy which is ESG centric or ESG aware. Um, for the purposes of the fund that we are launching, so which is already open as of now, the Invesco India ESG Equity Fund. In there, we are making the standards and thresholds a lot more stricter.
Right.
Today, at Invesco, we are in a way applying ESG upfront in our investment process. So we are, for example, like as I said, any company which has a score of more than 2.5 on ESG will not become eligible for the purposes of investment in any of our strategies, whether it is a new fund or any of our existing funds.
Right.
So in a way, we are now applying ESG upfront. It is part of our entire equity practice that we follow at Invesco. But for the purposes of this fund, we are then, making the decision of making the thresholds a lot more tighter. We are saying that for ESG centric strategies, the score should not be more than two. The portfolio level aggregate score should not be more than 1.5, and so on and so forth. So we are making the standards a lot more rigorous for strategies which are supposed to be positioned only as ESG centric strategies. So I think these are some of the building blocks which have gone into it. We've been putting this framework in place now for almost 3 years. We've gone through one round of improvement and enhancement as well. So what we're dealing with right now is actually version 2.0 of our own process. That is all in the works. I think this one last point, what I would like to say is that this is not something which is uh, ready in any respect, in the sense that the whole agenda of ESG investing, whether it is globally or whether it is in India, is only evolving. Processes and frameworks are also only evolving. So this is not the last word. We are all kind of grappling with new features, new information, new factors, new challenges which are coming along the way, and we need to kind of incorporate those. But this is a good beginning in my view, and I think we all, as our own contribution to making this world a better place, we need to become a lot more sensitive. So as guardians of capital, or fiduciary investors, or as individual investors, can also make a contribution by supporting or not supporting companies which are not ESG sensitive, are ESG sensitive or not ESG sensitive.
Absolutely. I think one of the key takeaways that I really liked, and that was going to be one of my questions, is in your other schemes, are you going to be ESG sensitive as well? And I'm so glad that you answered that in the positive, because I think if the world has to move that way, one scheme is not going to be the key. I think all our
Enough,
money,
absolutely.
yeah, all our monies have to be going to the companies that are more sensitive than not sensitive. Absolutely. My last question, Tahir. What returns should equity investors be expecting now? Because you're seeing where markets are, and everybody is sort of now looking at, say, okay, can we really make money from this level for the next 2 3 years? What returns would you expect equity investors to make, say, over a decade? I wouldn't say 2 3 years, but over the next decade, because we've seen equity returns kind of falling every decade, say even if you see 90s, 2000s, equity returns have been gradually falling, or I would say normalizing rather than anything. So, what do you think?
Yeah, so equity returns will be made for sure, and what of course is debatable, if at all, is the quantum and the amount or the time over which the returns will be made. And yes, I agree with your point of view that equity returns uh, have been kind of trending downwards decade after decade. But at one level, I think it is also to be looked in context of uh, you know falling interest rates. It is to be looked in the context of falling returns from other asset classes as well. And I think real returns to that extent have not necessarily compressed as much as what appears to be when we look at overall nominal returns. So nominal returns perhaps have trended down, but I think along with which inflation too has trended down over a period of time, and that I think means that real returns are not as bad as what it appears at first glance. So I think returns will probably, businesses are the only other living organism in a way which expands and grows over a period of time. That is one feature of businesses, that they only grow, and especially well-run businesses typically, give or take, generally tend to move upwards over a period of time. And as businesses grow over a period of time, I think there's no reason why value would not get created, and therefore investors who are part of those businesses will not make returns. So it is almost a given, but the trajectory of returns, etc., could probably differ. Yes, we've seen a very great, good, strong year in the last 1 year, and unexpectedly so. The way the markets have panned out, one would have never expected, uh, to have that kind of an outcome sitting 12 months back. But here we are. So, uh, if we were to go forward, probably it doesn't. One can debate that the strength of the returns may not necessarily be as good as what probably was the case in the last 12 months. But I think over a 2-3 year time frame, to be able to compound money from equities at the rate of somewhere between 10 and 15% should not be very difficult, even despite where we are today with regard to markets, valuations, as well as the economy. I think and more particularly in a country like India, where we still can, you know, manage to grow at a reasonably healthy rate. Aspirational growth rate may be 8, 9, 10%, but even if we probably manage to get back to our recent trend growth of 5 to 6%, I think uh, to think of 10, 12% as a nominal GDP growth rate, and therefore to look at somewhere between 12 and 15% of returns within the market is not something which looks very improbable, despite the fact that your starting point on valuations may not necessarily be as great. But the recent last 12 months, and probably particularly the you know uh, the depths of the pandemic in the early part of 2020 uh, does tell us once again that, look, if equities are bought at the right time, and especially when things are cheap, and
Yeah.
when markets come to the belief that everything is lost, generally becomes the best starting point. To be able to kind of bump up that return from that 12-15% mark to more closer to maybe the 20-30% mark. So I think one has to continue to use those kind of opportunities, not to shy away from the market, but to increase or enhance participation in the market. I think those are the times when we have to be a lot more stronger in our stomach than our heads, actually. So I think that is the name of the game. But I think in general, I would like to think that equities as a asset class should be something which should yield better returns compared to a good number of asset classes, especially over a 3 or 5 year or maybe even a 10-year horizon.
Great. Some good, encouraging numbers from Tahir there. Thank you so much, Tahir, for being with us today.
Thanks very much.
It was an absolute
Thanks for
pleasure
having me.
talking to
Thank you
you.
very much.
Thank
Same here.
you.
Thanks. Bye.